this topic. My expectation is this will be the most important class you attend in college. And if I am able to communicate to you the significance of this topic, in 20 years, if I see you, you're going to hug me because I will have impacted your family in a material way. That's how significant what I'm going to try and communicate to you is. I understand most of you, or some of you at least, are finance majors. That is such a great major. Within business, arguably finance is the most important specialty because without money, businesses fail. And when they have capital, when they have money, businesses succeed even if they don't have a superior product. And so finance, what I would say to you, if people say, what is finance? I define finance, it's the science of money. Science is supposed to be about the data, and so few practitioners in business understand the data. So that's the scope of the topic I want to, and the weight of the topic I want to bring up. Let's build on the professor's prayer here for a moment, and how great it is to see a class begin with a prayer like you did. Of all the universities I've spoken at around the country, this is the first one where the professor led us with the prayer. But let's ask the Holy Spirit to guide you and to help you understand. If I'm telling you BS, then may the Holy Spirit reveal that to you. And if what I'm telling you is wise, may He settle on you. So let's pray that together now, okay? Heavenly Father, we praise you. King Jesus, we praise you. Holy Spirit, we praise you. And we lift up your name, Jesus, the name above all names. And we thank you for all of your blessings, Lord. Lord, I thank you for the chance to be here with these young adults. Holy Spirit, rain down on each of them here. Fill them with your health and your wisdom. Help them to discern if what I am saying to them is from you, if it is true, then let no one stop us from helping them. And if what I'm saying is false, Holy Spirit, make it clear to them so that they may know truth. In Jesus' name, amen. So,
if you want to raise that,
could I please?
The button on the side of the wall.
Thank you so much. Just want to put up one little. Do we have any chalk or markers? Or do we not?
I got it.
Oh, great.
I got you covered.
Okay. So I just want to put up two things here for you to think about. Thank you so much. All right. So if I want to look at two time periods with you, just to start the conversation and get you thinking. So let's talk about stocks and gold for a moment. Sorry, my handwriting isn't too good. All right, so gold began trading freely over 50 years ago. Gold, the professor said, has some influence in global finance, but you know where gold is? It's way off here. Gold's off here in the corner. Very minimal focus in finance today, right? Minimal. I bet almost none of your families have any gold. All right, so since gold began trading freely over 50 years ago, what's performed better, stocks or gold?
Stocks.
Okay. Class says stocks. All right, now how about in this millennium? It's a reasonable answer because gold is about safety. Stocks are about risking all your money to make more money. So in this millennium, what's performed better, stocks or gold? Stocks? Okay. All right. And what do we think, if you were going to guess, this third row is saying U.S. ownership, percentage of assets of the average family in stocks and gold. So it's an average, but very current studies. Any guesses what the average family's wealth is that's exposed to the U.S. stock market now? I'll give you a hint, it's an all-time high. Never have American households have more wealth as a percentage of their assets in stocks than they do now. Any guesses?
150,000.
Well, as a percentage, because
Oh,
it changes
percent,
as a
sorry.
percentage, yep.
7 to 10%?
40. 40% of American wealth is in the stock market right now. What percent would you guess of American wealth is in gold?
Less than 1.
Exactly, great answer. Essentially 0%. Essentially 0%. So, finance, the science of money, data, this is what you should be looking for, not people's opinions, the data. The reality is, since gold began trading freely, gold has outperformed stocks. Shocking, isn't it? And by the way, most financial advisors don't know this either. When we finish this, you should know more than many professional financial advisors about gold and data. And in this millennium, class said stocks, again, the answer is gold. Yes?
Which stocks? Are you just saying, like, every stock from startups to Apple? Or like, because there's definitely specific like ETFs that outperform gold, right?
And there's definitely some stocks. So everyone heard his question. When you say stocks, how do we measure stocks?
The index?
Exactly. You pick an index for it. Because you're right. Apple, Amazon, right? They have outperformed gold. But if you're going to talk about an asset class, you want to refer to an index. And what's the most popular index today for equities?
S&P.
S&P 500. Now, this does include, this is measuring the S&P total return index. So that includes reinvesting dividends. So that's a high hurdle to get over. So gold is outperformed, but 0% allocation. Isn't that crazy? Maybe it's because of the risk profile, right? Because not all returns are equal. If I go to the casino and I bet $10,000 on blackjack and I make $10,000, I double my money, versus if I go to an investment such as gold and I make $10,000, nominally, those are the same percentage returns, right? 10,000 and 10,000, but the risk profile is totally different. I could have lost everything at blackjack easily. The odds are I'm going to lose everything, right? But with gold, history says this is the safest asset in finance. Because if I go back to ancient Greece, ancient Rome, China, no matter how far back I go, gold has preserved its purchasing power. You look in some of the writings you read in high school from ancient Greece, and it would talk about, buying whatever, an outfit for a senator or shoes, and it would reference that as a weight in gold. You fast forward to today, all these currencies in between, it's still the same. Gold still can buy you those same things. So why is that significant? What is the difference between barter and commerce? Who can tell me? Anybody? Oh, sorry, go ahead.
Barter is like up for discussion. You have to find out what the price is by communicating to someone, whereas commerce, a price is usually just given.
Good answer, good answer. So what you're describing is what we would call price discovery. Like what is the price, whether it's a stock or a house or whatever, how do you discover it? But barter, technically, anybody, go ahead.
It's good for good.
Good for good, exactly. It's real asset for a real asset in the absence of a currency. So is bartering, think about bartering. What about the challenges of it? Is bartering efficient or less efficient? Less, right? Does everybody get that? I mean, it's so inefficient, right? If you make those water bottles, right? And let's say I grow cattle and I sell steaks, and you want some steak. I only want so many of your water bottles. Or if you make shoes, or if you make hats, whatever it is, right? I mean, a seller only wants a certain amount of most goods, but the seller will gladly take money, right? Money is the difference between barter and commerce. But it brings up a critical question. what is the function of money? There's two functions for every kind of money, whether you're talking about the euro in Europe, the drachma. Money has two functions, it's very basic.
Store of value and unit of account.
Excellent. A store of value and a unit of account. Unit of account meaning the way to trade and to do commerce, right? So the dollar, A plus in terms of being a unit of account, right? You can go into a store, everybody will take it, go around the world, people take it. You can do it on you can use it on a credit card, right? Very easy. But is a store of value that protects your purchasing power. So if we go back again 50 plus years, August 15th, 1971, Richard Nixon delinks the dollar from gold. Up till that point, going back to our Constitution, the dollar was backed by gold. You were able to take your $20 into the bank and they would give you a physical gold coin in return. 50 years ago, we delinked from the dollar. What has happened to the purchasing power of the dollar since we delinked? And by the way, August 15th, 1971, Richard Nixon looks into the eyes of every American citizen. Only 3 channels back then, everybody's watching them. And they all had them on. And he said, I'm going to debunk these concerns. Your dollar is going to be worth just as much tomorrow as it is today without the gold. President of the United States telling people emphatically, your dollar will be worth just as much tomorrow. 50 years later, what's the value of the dollar since he did that?
Isn't compared to gold is worth like $3,000 less?
All right, well, let's talk percentages again, right? So the percentage purchasing power of the dollar since it was delinked from gold, down over 95%. So you know how you hear your parents talk about, hey, when I was a kid, $1 bought a gallon of gas, dinner, movie tickets, right? And you have this sense, oh, that's nostalgic. That's yesteryear, how sweet. No, that is the treasonous betrayal of our government who has failed to protect the wealth, especially of the working class. So the dollar is down 95% in terms of its purchasing power. When you see how much more things are costing, when you go into supermarkets, you guys probably notice it now too. You go in and you buy vegetables, and now they cost $7, and a few years ago they cost $3. Less than 1 in a million people in America understand your vegetables don't cost more today than they did yesterday. Your dollar's worth less today than it was yesterday. What's happening is the dollar is losing purchasing power and value. Gold, since it became delinked from the dollar, how has that performed relative to the dollar? Any guesses on a percentage basis? Did you say 7,000%? You're right, it's up 7,000%. 7,000%. Not bad for an asset that history says is the safest. It's never defaulted. It carries no liabilities. It's just an asset. It is the most widely accepted asset on the planet. Now, I think this moment in time when you guys are sitting here in finance and you're thinking about careers in finance, this is the most exciting moment in finance. Not only in your lifetimes, but in your parents' lifetimes. Trump just put a new Treasury Secretary in place, Scott Bessent. He said he wanted the job because we are on the brink of a reordering of global finance. Because what happened was after World War II ended, in Bretton Woods, New England, all the nations got together and they said, we're going to make the dollar what's called the sole reserve currency. So anybody who wanted to do international trading agreed they would trade through the dollar. It's called an exorbitant privilege. If you're anybody but America, it's a terrible deal. A terrible deal, right? If I'm one country, if you have France and Germany, and they want to trade, they don't trade currency for good. They trade dollars to currency. Dollars to good, currency to good. It's a three-way mechanism that enriches the dollar in America. That's the system that's been in place. And this has happened 5 times before in history, going back to the Portuguese escudo. Every time through the centuries, it comes to an end. And the citizens who saved and that paper currency that was losing its sole reserve status were destroyed financially. Destroyed. So finance is the science of money. We should be aware of this data. Americans, 0% allocations, have no clue what's going on. All these nations are saying, we don't want the dollar because look at what you've done with your debts. You have been irresponsible. And look at what you've done to Russia. Joe Biden says, yeah, you can't use your dollars anymore. Boom, there goes 15% of the country's wealth. Why would they trust us? So what else are you going to use? If you look up the word money in the Chinese language, you'll see there's 2 characters. Look up the word money in the Japanese language. You'll see there's 2 characters, like 2 images, right? Both of them have an identical image, even though they're distinctly different cultures. It's an image that looks like a house. That's the character for gold. In Chinese and Japanese, gold is embedded in their understanding that gold is money. Right now, Americans think gold is this funky asset that has no real value. Only Americans are so ignorant that we don't realize what gold is. Gold is money. The chairman of the Fed said, gold is the world's premier currency, bar none. Nothing can compete with it, including the dollar. So here we are, as Besant says, on the brink of this reordering of global finance. Every time so far in history, a sole reserve currency has gone into that reordering, it has been decimated. Every time so far going into that reordering, wealth has transitioned to gold. Why? Let's think about it. You guys, let's think about the BRICS, what's going on right now. You guys familiar with the BRICS? Anybody? What are the BRICS?
The new, well, kind of new allegiance between a bunch of countries trying to push the new currency.
Exactly. So BRICS is an acronym: Brazil, Russia, India, China, plus maybe 15 other countries now that compose about 80% of the world's population. And they're getting together, they're saying, we desperately need an alternative currency besides the dollar, because it's a liability for us. So they've been talking for years about this basket of currencies that are going to come together to form the BRIC. But what happens behind closed doors when they get down and it comes to brass taxes, right? Let's say you're China, let's say you're India and you're Africa, and Africa says, let's all do it equal. We got 15 countries here, everybody's country's going to have 1/15 the value of the BRICS. So the little countries that have little economies think that's a great deal. But if you're China that dominates, you're like, no way, guys. We're not doing this. China's going to be 60% of this currency. It's up in arms. And then what happens next year after you negotiate this year when all of a sudden somebody's economy crashes and someone else's explodes? Then what are we going to do? We're going to come together and we're going to revalue again collegially how this should be. This is an absolute food fight, right? You never see agreement. That's why throughout history, the agreements break down because of our self-interests. But what they're saying is the one currency that has the network effect, that is why Facebook is worth a fortune and joessocialmedia.com is worth nothing. When you have a massive number of users, that's the network effect and it creates money. No currency has a network effect like gold. So these countries are realizing, how are we going to agree on trade? It's going to come down to gold. That's what they're saying. So we have this set up here in time, and what we are witnessing is, I would say to you right now before your eyes, the destruction of the cornerstone of Western finance. Everybody's financial advisor builds all the recommendations for their families on this one cornerstone of Western finance. What do U.S. advisors tell you is the risk-free asset?
Treasury bills?
There you go. The U.S. Treasury bill. What's the difference between a bill and a bond?
bills for less than a year.
Exactly. So if I'm the US government, just to make sure you guys understand this, if I'm the US government and you're a citizen, and I'm the government, I need to borrow money, right? If I'm gonna pay you back in less than a year, that's generally called a bill. Bonds and bills are just IOUs, right? So I'm the government, I'm borrowing $1,000, generally face value, from you, and I pay you back within a year, that's considered a bill. A bond is I'm gonna pay you back in up to 30 years, right? But a bond has more risk because if interest rates rise, then the bond goes down in value dramatically. So the concept is that the 3-month treasury bill, which is based on the dollar, is risk-free. All of finance is based on that assumption today. So the government's going to pay you back, right? Because they have a printing press. It's not linked to gold anymore. They can print everything. That's what they're doing. But what they can't guarantee you is what they pay you back in will have the same purchasing power as what you lent them, right? So every year, the dollar and paper currencies are worth less and less. So when you have an IOU in an asset that someone owes you that's deteriorating in value, how good is that? And what if that asset's deteriorating in value quickly? Or what if something changes? And as has happened in 500 out of 500 case studies through time, that asset goes to zero while you are the creditor. That's not a risk-free situation. So what do? This is what your advisors are building. They're still telling your families to build on this model. How that flows through, if the dollar is risk-free, then bonds are safe. But again, someone owes you an asset back that is losing value. And as debts grow, our debt, how big is US debt now on balance sheet, approximately?
$36 trillion or so.
How much you say?
38 trillion.
You said 36 or 8, you're right there.
Trillion.
You know, it could have changed to 38 since the last time I looked, a couple weeks ago, right? 36 trillion. What are our revenues as a country, our tax revenues? Revenues, what we bring in a year? Any guesses? 4 trillion. So think about this. 4 trillion in revenues, 36 trillion in debt now. And by the way, our interest costs are going up and we have a ton to refinance. If Trump were to take government spending to zero for 4 years, let's make the ridiculous notion that wouldn't even have a negative impact on tax revenue. So we continue to get 4 trillion in revenues for 4 years. And he takes every penny of those tax revenues and uses it to pay down our debts. We're going to pay down 16 trillion debt. We're still going to have over 20 trillion in debt with revenues of 4 trillion. The math doesn't work, right? So every time in history, finance is the science of money, it has happened where a country can't pay back its debts. That currency loses purchasing power, which essentially means inflation breaks out. The classic definition of inflation is not an increase in the prices of goods and services, it's an increase in the money supply. Because when the money supply increases, then the prices of goods and services increase as an effect of that. Our money supply is vertical, right? We've printed more money in the last few years than the country had in the first 200 some. So if you're a financial advisor, you're recommending people, you're telling them, our models are built on the treasury bill as risk-free. That means bonds are going to be safe. And in low inflation environments, stocks have big PEs. So if you were looking at this quickly here, all right, so inflation, right? PEs for stock, I'm sorry, PEs. When inflation is low, this is 0. You know what? I'm so sorry, I drew this backwards. When inflation is low, like inflation's at 0, the PEs are super high for stocks. So when was the low point of inflation, interest rates in modern history? COVID. March of 20, Treasury bills go under 1%. First time ever. PEs hit at that time over 50 times earnings, right? Now, how about, just to think about, again, just using the data, 1980 was the last inflationary peak, right? Inflation has cycles. What were the PEs on the stock market in 1980? 8. So PEs were 6 times as high, right? And why does that make sense? Because how do you value a stock?
It's returns.
What's that?
It's returns.
What kind of returns?
Positive.
It's the cash returns, right? Good answer. The cash returns, right? It's how much cash you're gonna make. And so when you look at a stock, you say, okay, it's making $1 million today, it's gonna make $1 million next year, and the year after, and the year after. But the further out of that money stream you're looking at, the less value it has, right? Because again, the dollar is gonna lose purchasing power. So you have to discount back. You guys definitely wanna learn this. It's the same for how you value stocks, bonds, real estate. It's the discounted cash flows to today. The lower the interest rate, the more valuable the stream, the higher the PE, the better the bond, the more expensive the real estate. The higher inflation, all those financial assets get crushed. So think about it. Americans have record exposure to stocks. We're coming from a period where PEs have been at an all-time high, inflation has been all-time low. We're going to a period where inflation is going to rear its head. History says that's what's going to happen because we can't pay our debts. The worst possible allocation. What has consistently thrived in inflation? Real assets, of which America says gold is this goofy commodity that has no value. I say to you, gold is the most valuable of any real asset, more so than oil or cotton. You say, well, I can't drive it, I can't eat it. Why is that the case? Because that's what keeps us out of barter. You go to Saudi Arabia today, they'll sell you all the oil you want if you give them gold. They're not going to necessarily take your scripts, meaning your currencies. We'll take that. Anywhere you go, any real asset you want to buy, we'll give it to you in gold. We're heading into this inflationary environment. Americans have 0% gold. 0% gold. It's the worst possible lineup, which is not uncommon, right? Historically, families do the worst thing that they possibly can. Now, I want to just touch on for a minute here too, what we are coming through so you appreciate it. Quantitative easing. Say it's the most significant financial event, since you guys have been in college, probably the last 15 years. What is quantitative easing?
They're putting more money into the economy, essentially.
Right, the government prints money and puts it in. But this time, it was very insidious what they did. This gentleman said they put more money into the economy, but with QE, what did they do with the money?
For 2020.
And going back to 2008, we had a financial crisis in 2008 where we had too much debt. And instead of letting it heal, what the government did was they spent $10 trillion and they bought bonds. Why did they buy bonds? Because T-bills are supposed to be the risk-free rate. When rates start going higher, then that means there's a problem. Inflation is out of control, and that means real estate's gonna be worth less, not worthless, but worth less. Stocks and bonds will be worth less. So the government bought $10 trillion of bonds to force rates low because they knew the free market would not price them there. They destroyed price discovery. When you hold up your phone and you look at, oh, here's Apple, here's Google, here's the stock market, here's all the assets you're looking at. When you look at your phone next time, I want you to realize every single price you see on your phone is wrong. It's completely wrong. You guys have studied economics at some point, and you have these equations, right, that are fundamental economics. And in those equations, you'll see the letter G, right, as part of those equations. What is G in economics? What does it represent?
Growth rate?
What's that?
Growth rate?
Good guess. Government spending. Usually, government spending. When you look at how to value a financial asset, discounted cash flows, there is no letter G in that. Because markets are supposed to be about price discovery. What's the buyer willing to sell for? What's the buyer willing to pay? What's the seller willing to sell for? We find equilibrium, okay? When you inject government spending into that, it distorts it. Because the government's saying, oh, well, we don't want the seller to have to come down that low. We're gonna artificially prop it up. And when you put $10 trillion in, you destroy price discovery. I don't know what's gonna happen when this ends, but realize, going back to ancient Greece, governments have tried money printing to support their investments in their economies, and it's failed every time. World War II, when the US Allies won, they took over Germany, and they cut off the artificial support of the DAX, the German index, fell 90% in one day. Government has spent $10 trillion. It's such an absurd amount of money to buy. We just saw something happen that's never happened in 5,000 years of finance. Bond rates went negative. We've blown price discovery out of the markets. All these prices are so crazy. What do negative bond rates mean? It's never happened before. All right, let's turn that T-bill equation around. Let's say you're borrowing money and I'm the lender, right? So you say to me, hey, I want to borrow $1,000 from you. I say, okay, what are you going to pay me as an interest rate to lend you the money? And you say, you're going to pay me. You're going to pay me for the privilege of lending me money. How arrogant is that, right? It's like punch him in the face and walk away. That is literally what happened with negative yields. How did we get those negatives? Because the government bought so many bonds, they drove the prices to a rate that we have never, ever seen in finance. So think about that. If the government has artificially elevated bond prices, that means stock prices are artificially elevated, because artificially elevating bond prices means yields are low. That means PEs on stocks are high. How does that impact real estate? What happens if bond yields are artificially low? Mortgage rates are artificially low. So instead of your $2,000 being able to afford a $100,000 mortgage, now it can afford a $200,000 mortgage. Literally, it's a crazy difference. So all of a sudden, the borrower's out there, the buyer's out there, and he's thinking, I can buy twice as much. What have we seen? Property prices artificially rise because of this distortion. Gold is the only asset I'm aware of, you guys can find one, I'll buy you dinner, that has been inversely correlated to stocks and bonds. What does that mean, inversely correlated?
I assume when prices go up, gold goes down, and then when gold goes down, or sorry, the other way, when stocks go down, gold goes up.
Exactly, that's all it is. So what an appealing attribute to have an asset in a portfolio that performs well when the dominant allocations don't, right? And by the way, we haven't really needed gold yet, but it's still outperformed stocks this whole time. How absurd is it that we have 0% allocations? So if gold's inversely correlated and stocks and bonds and real estate are artificially rich, what does that suggest about the gold price? Artificially cheap. And you say, prove it. Think about this. Let's say today the government takes their 10 trillion out of the markets, and they won't do it because they know the system will crash if they do. They take out $10 trillion, right? So they're sellers of 10 trillion of bonds. Bond prices, are they gonna go up or down? They're going down, right? 10 trillion out of nowhere. That means stock prices are gonna go down. That means real estate prices are gonna go down. And then people are gonna ask the question that they've never asked, what really is safe? You know, nobody worries about safety when the government's printing money, everything's going artificially to the moon. But when things start blowing up, then you start asking the right questions. What is safe? And as soon as you ask what is safe, all roads lead to gold. What's your time frame? Millennia? Centuries? Decades? It's protected well. So the primary role of gold in the portfolio is just to protect wealth. It's not to say the sky is falling, the world is ending, bunker down and buy gold. It's to say, when you construct your portfolio as a family, you want to decide what percentage of my portfolio, of my wealth, am I willing to take risks and to buy Amazon, to buy Apple, to buy whatever, because I think it's going to go up. And then you make that decision. But what percentage of my portfolio do I want to have that's really safe, so that if my investment in Apple blows up, I'm not destroyed, I don't wreck my family. Now, at your age, you're young, you usually don't have a whole lot of money, just pedal to the metal, you just want to make money. But think about your parents. How painful would it be for them? How blindsided would they be if they had an allocation that was crushed and they hadn't been thinking about, oh my gosh, there's risk here. So gold, you want to allocate a percentage of your portfolio to it. So when you put your head on the pillow, while it has no guarantees, so far through the centuries, it's worked in protecting families through every crisis. The irony, coming back to again, we are destroying the cornerstone of Western finance, that the T-bills a risk-free rate. Part and parcel to that is the teaching that you hear that a little bit of risk, you only can get a little bit of return. You have to take a lot of risk to get a lot of return. That's part and parcel with the T-bill as a risk-free rate. That is being upended too. And I submit to you, you buy gold for wealth preservation, for defense. But because it's so finite, gold is less than 1% of global wealth. We can't change that with mining, right? There's new gold coming out, but you can't move the needle on that. Think about it. If gold is 1% of global wealth, the whole world basically has none. If the 99% of people wake up and they say, I want just a little bit of safety, I want just 1% of my portfolio in gold, it will take all the gold that's been mined in time. That's not going to happen anywhere near these prices. What's the appropriate allocation? So if we go back in time, again, finance is the science of money. You go back to the Great Depression, which is the oldest data set we have that's reliable, 1929. If you wanted to optimize a portfolio, and we use the Sharpe ratio to do that, right? Sharpe ratio tries to say, what's our return, what's the risk we've taken to get that return? So we have some recognition that going to the casino is different than a more traditional investment. If you wanted to optimize your portfolio using the Sharpe ratio, going back as far as we can at that, 1929, you wanted a 15% allocation to gold. Since gold started trading freely, that number rises to 20%. In this millennium, the number is 25%. America's at 0. Doesn't mean you have to get to 25. We say to every family, every investor, but 0 is really impossible to defend if you want to be wise about what you're doing. Think about that. If 1% allocations for the world are going to take all the gold that's out there, how are people going to get to 15%? The only way to do it is if the price explodes. That's what history suggests is coming. The irony that the safest asset in time potentially also has such dramatic upside. So, 2 last thoughts. If you were sick, let's say a relative was going to be going in for a major heart condition, right? And it was serious. What would you do? Would you go to the receptionist at the local hospital and ask him or her what you should do? The receptionist? Would you go to a good doctor at that hospital? Or would you go to a physician who had successfully handled case after case like this? You say, it's a stupid question. Of course I'm going to go to the physician. But think about finance. The financial advisors that are guiding America, they're really the receptionists to greet people and bring them into their financial firm. What are they telling them? They're telling them what their firm tells them is going to be the most profitable for the firm. This stuff about fiduciaries is very superficial. It's disingenuous. who are the people who have negotiated these markets so well in our generations? They're the ones you should be looking to get an assessment for what is the risk and the return potential in the markets today. While investors are all in to the markets as being so exciting that they're there, the greatest investors of our generation are to a person saying, there are risks in these markets like we've never seen in our careers, whether it's the valuation risk, the debt risk, the geopolitical risk, off the charts. So I would say to you, think about it, talk to your, whoever you love, are we listening to the receptionist, or are we listening to someone who has a demonstrated track record of recognizing when to put the pedal on the metal and when to preserve your capital? The last thing I'll mention before I give you one proposition is, in this atmosphere, it's so great to be able to talk about the Bible. Gold is talked about throughout the Bible. There's 3 quotes I want to tell you about. The first one is in Genesis. Before God kicked mankind out of the Garden of Eden, he told us where to find the gold. Kind of crazy, isn't it? Don't need any commerce in the Garden of Eden. It's that important that he told where to find the gold. Fast forward after we've been kicked out, and God says, the silver, this is in the book of Haggai, the silver is mine and the gold is mine. So God himself identifies with gold and silver. By the way, everything I said about gold applies to silver too, right? So gold and silver, they're both precious metals. So God says the silver is mine and the gold is mine. God identifies with gold and silver. Interesting. And then fast forward to Revelation. The only asset the Bible counsels us to buy to be wealthy is gold. And Americans have 0. Christians have 0. There's a reason God said to have some. Okay, not all, but some. So, in closing, I had a chance to be in your seats as a finance major. I went to Wharton, and there was a guy named Michael Milken who came to school. And he said, hey, we'll pay you guys for any business you can send to us. And the students had a chance to make a lot of money doing that. Beautiful thing about gold is that it's unregulated. You don't need a license to be paid for it. So, to the extent any of you, as you start thinking about this, your mind's going to open up. You're going to recognize truth. You're going to see the data. You're going to see it makes sense to have some. But because financial advisors are so anti-gold, most people don't have any idea how to go about it, how to do it. All we do is we allocate the physical, we send them the bricks, we store them for people, transport them. So if you guys are looking for alternative sources of income this semester, how nice would it be to send your parents a check for your tuition? Let us know. If you find people who are saying, yes, I know, I need it, I don't know where to go, reach out to us, and we'll be delighted to compensate you to work with you. And I say to you, the more you learn about this, you're going to be able to put your head on the pillow, knowing that anybody, whether they're paid for it or not, you recommend have some, you're doing them a great service. Not only is the Bible supported, but the laws of finance supported. That's what Americans need to hear. So if we have time for a couple of questions, I'm delighted to take them, Professor, or
We have 15 minutes.
if anybody has any.
Yeah, so do you think that people don't really see gold as value because the charts don't show like big returns like some stocks do?
Great question. Why don't people understand the importance of gold? Well, this is a 2-day talk in itself, right? But, and this may seem controversial to say, but I'm going to guess you're of the maturity that if you look back now to COVID and the hysteria around you know, COVID's going to kill the whole world. It was the 36th iteration of a respiratory virus called corona. And then you got to get the shots or you're going to die. dead Americans from the shots. That's probably underreported, right? Where did this come from? There was a big profit motive to push those shots, to push that narrative. I submit to you the same thing's happening with big finances. We saw with big pharma, you guys probably are of like mind, big food, where there's tons of our food supply. Big finance is pushing this. I don't know if you realize this, but they changed the Hippocratic Oath in medicine. Doctors used to have to pledge, I will do no harm. They removed that from the Hippocratic Oath so that they can push drugs and other products that they're subsidized to push and not be held accountable. I submit to you that's a major reason why people don't understand gold. It is such a disinformation scheme because financial firms talk about this concept of selling away. If you're a financial advisor, you are told you can't recommend any other assets besides what we have here, or not only will you be fired, we're gonna look to take your license away. It is just control. And they say it's all about risk. I submit to you it's not. Having worked on that side, it's all about their margin. If you take a half an hour with your family, anyone you love, and just look at the basic fact, like disregard what I'm saying. You go look at the price of gold in 1971, look at the price of gold today. You'll see all this data. It's so clear, it jumps off the pages. How could we be so upside down on our understanding? And I say it's just like what happened around COVID. The disinformation came out then.
For gold, I'm just trying to understand how it works, because I guess with stocks, it goes up because more people are buying it. With gold, is it that the currency is getting weaker, and so naturally gold is getting worth more, but ultimately your purchasing power is staying the same, or will your purchasing power increase in the same way that it potentially could with rare exceptions in the stock market?
Great point. Gold too, like stocks, like every asset, is a function of supply and demand. But it is interesting what you're bringing up. So as the dollar loses purchasing power, it does also negatively impact the real purchasing power of a stock, right? You sold the stock for $60 last year, you sell it for $65 this year, but it really could, on a real basis, that purchasing power would be worth less than it was last year because the dollar has appreciated in value, right? So historically, go back to ancient Greece, you can see where it has preserved purchasing power. But could it, and that's why we want to buy it, right? I'm telling you, the reason to buy gold is defense. It's the part of your portfolio that preserves well. However, there are moments in time where its purchasing power rises notably. So, for example, when we came off of the gold standard, people had a choice. You know, they could have held gold and held just dollars. If you held dollars and you wanted to buy a home, you needed 18 times as many dollars to buy the median home because the dollar was decreasing in value. If you had the same amount, the same dollar value of gold in 1971 as you did at the end of 2024, you could have bought 3 homes with that same amount of gold. So I would say there is a case to be made that the purchasing power will increase with it. Like anything else, I can't look you in the eye and guarantee you, right? But that's data. I can say, hey, here's the data. That's what we want to hang our hats on. And what's the probability of how something's going to come out? So that's my expectation. But to your point, I want to talk for a minute now about gold losing money, so you're aware of this. From 1980 until 2000, gold traded down. So if you had bought gold in 1980 and you sold it in 2000, you lost over half your money. That's a 20-year period, which, by the way, coincides with much of your parents' working careers. You know, they say humans, we overweight our own experiences rather than being able to separate our emotions and look at the data sets, right? We know that. So from 1980 to 2000 was the most atypical period, I would tell you, in financial history. I had a chart I could show you the history of interest rates going back thousands of years. There's only been one time when the sole reserve currency was able to sustain a 20% interest rate. That was the United States in 1980. This is so significant because what people don't understand, we were talking about this chart here, with PEs high when inflation is low and low when they are high. Just flip this chart. 1980 is when gold peaked in the last inflationary cycle. And then what we saw was inflation plummeted from 20% to less than 1. So as inflation plummets, it's great for bonds, it's great for stocks, it's great for real estate. And you don't have a real need for gold other than your emergency allocation. 20% interest rates to zero is perfection for stocks. And what happened? Again, multiples in the stock market went from 8 times ultimately to 50. The question is that what we want to expect from today? Do you think rates went from 20 to 1? Do you think rates at 5 are going to negative 15? Do you think we're going to see a replicate of that? Or, again, history says with our debts, inflation is going to be rising. We put out a report in 2021 saying once in a generation, that was what we called it. Because we think this time period right here around COVID was a generational shift. Once in a generation, this change happens. But there weren't neon lights flashing from the government or from your financial advisor telling your families, we've just changed this paradigm. Because now, if inflation is rising, that's great, that's great for the prices of real assets, bad for financial assets. So I believe history's clear. We're going to see an increase in purchasing power of gold because of this backdrop. But there have been precedents where it hasn't happened, most notably 80 to 2000.
So before 1971, what percentage of U.S. ownership was in gold instead of stocks? Because, you see now 0% and 40% in stocks, but that had to be different before we dropped the gold standard.
You're right, it absolutely was. And that's a great question. I'm going to guess U.S. stock, the percentage of U.S. households with their worth of equities and stocks back then, I'm going to guess was under 10. I don't know. I don't know that exact number. It was clearly way lower than it is today. And gold, theoretically, was still part of our currency up to 71. It was dramatically more. Let me speak to that with a different date than 71, because most significant, so just to give you the history here, I think you guys love America, right? I mean, what a great country. Our founders were so brilliant what they set up. So the operating system for our country was the Constitution, written in the 1780s, right? Article 1, the first article of the Constitution, you know what it says about money? It says the only legal money in this country will be gold and silver. And they felt so strongly about that, they put out an act in 1802 where they specified the only crimes that would warrant and deserve the death penalty. Only one crime was so heinous that they said, our founders, it deserves the death penalty. You know what it was? If anyone should try and change our money supply from gold or silver, quote unquote, they shall suffer death. Either they were crazy, or what I submit to you is they were great historians. Because they looked back through time and they saw what I'm telling you. Every time a country has its currency backed by nothing, like the dollar is today, it ends in complete ruin for the citizens. Their savings go to zero. How demoralizing is that? It destroys the fabric of society. So they put this in place. And that was in place up until 1933. I'm going to give you the 3 dates here. 1933, when FDR treasonously took gold from the American people. He shut the banks down, took the gold out of the safety deposit boxes, paid paid them $20 cash, but as soon as the world recognized that America had broken this constitutional mandate, gold repriced 70% higher. That was treasonous. To the middle class, the next phase was in 1964. Lyndon Johnson is president. And up to that point, money from the banks, dimes, quarters, half dollars, dollars, were real silver. See, notice, our founders didn't put us on the gold standard, they put us on what's called a bimetallic standard, gold and silver, to protect the working class. Because what would happen in time is, if you were working in a factory or on a family farm, you often would be paid in what was called a scrip. And you say, like, here's a Jones Farm dollar. And then you would take that Jones Farm dollar and you go into town, you go to the grocery store or whatever, and they would exchange it for you. But obviously, you know, the working class, that's not good, because you leave town, you leave your money behind, you don't have portable wealth. And they knew, founders knew, working class wouldn't be paid in gold for the day, because gold's too valuable, but they would be paid in silver, which is what has happened all the way back to the Bible, right? So by paying people in silver, you were protecting the working class, because then if you change jobs, you could take your quarters and your dimes, and you'd have real silver with you. So all the way up until 1963, 64, the working class in the United States could go to the bank and say, give me my silver. And so what we saw from that period was the blossoming of the most prosperous working class in history, because they weren't being paid in a script that was just paper promise losing its value. They were being paid in an asset that was preserving its wealth. And then the final iteration was in 71, when Nixon took us off of the gold standard, and there was no linking at all to it. The middle class, the working class in 64 was so much more prosperous now. Granted, it was probably unsustainable given post-war and our unique situation, but without a doubt, I mean, if you look at the average savings of a U.S. family in 1964, called $10,000, that's worth, I think, $250 in silver today. Average middle class family probably has $10,000 in net worth today. So that is how it has played out over time, especially recognizing those three key dates in American history.
If I'm looking to retire, let's say I'm like a working man planning time out, not me personally, one popular method that people use is they put their money in an index fund, and by the time they're finished that $1 million or $5 million, and then you can put the $5 million in a CD. My grandmother did this for a while. She was doing real estate. But if the CD is, like you said, in the same way that a treasury bill is paying you an interest rate, but your purchasing power could be less in the next couple of years, is there any way, like, is there like a gold-backed CD or something like that you could get a nice return so you can live off the interest without touching the principal, so you can retire, but you don't lose your purchasing power?
So let's talk about that in a retirement setting and in a taxable setting.
Okay.
So in a retirement setting, and this happens to so many people, like we see police officers, teachers, they leave a job, they retire, and they have this old 401k or a 403b, and it has these choices that they're not really excited about, the stock index, and they're worried that market time, think, what can you do? You can transition your money from your old 401k, your old company retirement plan, into a physical gold IRA, and that is something that my colleagues here specialize in. They do nothing but that, and it allows you to essentially wire cash from your old legacy retirement plan into your new self-directed physical gold IRA. And then gold or silver are bought for you. It's not levered, it's not borrowed against, it's not hypothecated, it's just yours. So if you buy 43 1-ounce Canadian maples, anytime you want them, you can say, give them to me, or you leave them in there until you retire, and then you take them out at that point, but they're yours. And the significance of this is that, again, the world has less than 1% wealth in gold now. I submit to you, if you do a little research and you look at the leverage in gold and silver, and you see these financial products like ETFs, gold ETFs, you're gonna see there could be, depending on the study, the perspective you read, more than 50 times as much promissory gold as there is physical gold to back it up. History tells us that's gonna be a problem. That's what they call musical chairs, right? Whereas when you have a physical IRA, it's segregated, it's yours, and you can take it any time. And we think wealth is gonna really transition well for people who do that. In a taxable account, we've done research and said, okay, what if you had held treasury bills? Because you're right, it's almost addictive, right? You say, hey, I'm gonna get this 6% yield. That means that's whatever, how much money you invest. I can pay my utilities with this. I can buy my groceries with this. So you just count on that 6% yield, whatever the T-bill yield is, right? Well, realize that bonds are yielding, I should know the exact rate, but I mean like minimal amount right now. Contrast that with the long-term average return of gold, which going back to, for decades is over 8%. And these are in periods where we've seen record stock market valuations, right? And gold has still returned over 8%. So when you do the math, if you do the math yourself, what you'll see is that it has been better to buy gold and then to sell it off in pieces as you need expense money rather than just keeping it in treasuries. And I think that's going to become even more of a discrepancy moving forward. So how we would articulate that to people is you don't want to be super tight on cash. We say have 6 months or 12 months of cash on hand, right? Because gold can trade down, right? And it may trade down, right? I could be wrong about everything I'm saying. The probabilities are that we're going a whole lot higher, but there's no guarantees. So you allocate, so you have, say, 6 to 12 months of cash to cover all of your expenses. And then say it's 12 months. Okay, I'm set until next February. And then next February, it comes time, you say, okay, I'm gonna need X dollars for the year ahead. Okay, X dollars for the year ahead. And then you would just sell the gold and have the cash. The probability is such that you will have done better than if you did it in treasuries. Thank you all. God bless.